The S&P 500 ended the month of October with about a 2.5% gain, marking the sixth consecutive month of monthly positive gains. For the month of October, looking back at my 5 stocks I recommended back then, we covered the likes of Amazon, Nvidia, PayPal, Vistra, and Phillips 66. Only one of those stocks finished in the red on the month, and that was Vistra. Otherwise, Amazon and Nvidia knocked it out of the park with returns of 11% and 8% respectively. But turning the calendar to November, I have 5 brand new stocks for you to consider for the month of November, so make sure you stay tuned throughout the entirety of today's video. And regardless of what type of investor you are, you've been hearing it over and over for months now. Investors expecting a correction. However, when you look at the S&P 500, here we are sitting near another record high. But when you start to look under the surface, you see things like the RSP or the equal weight S&P 500 not performing all that well. This could tell us that the Mag 7 might be holding things together. Taking a look here, you can see that the equally weighted S&P 500 over the past month is actually down close to 3%. But outperformance like the likes of Amazon and Nvidia that we just talked about are making things look better than expected. A stat that I recently saw showed that 30% of the S&P 500 is actually down 20% or more from their recent 52-week highs, which tells us that under the surface, there's a number of stocks that are already going through a correction. So make sure you stay tuned throughout the entirety of today's video. It's going to be an important one. But before we jump in and unveil the stocks, do me a huge favor. Show your appreciation by simply clicking that like button down below. Subscribe to the channel and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you can check out their 10 best stocks to buy right now. All right, let's jump straight into our video, taking a look at 5 brand new stocks to consider for your portfolio in the month of November, beginning with stock number 1, which is going to be AbbVie, stock ticker ABBV. And when it comes to AbbVie, it's one of my favorite positions in my portfolio, one of my longest held positions in my portfolio, and a top performing healthcare company. That was until recently, and we're getting a little bit of a sell-off that could have me sniffing opportunity. The company currently has a market cap of $374 billion, making it the largest company we're going to look at today. And over the past 12 months, shares are up 8%. Year to date, though, up 21%. However, since the stock hit a record high of nearly $245 back at the beginning of October, shares of AbbVie have fell roughly 12%. Again, being in a correction on its own, even with the S&P 500 sitting near a new record high. If we, in fact, from an economic standpoint, fall into a slower economy, that's going to be okay, because healthcare is where consumers still spend money. They don't ask themselves, well, what's the economy doing, before they have to take care of their health. It's a defensive sector. The company recently reported their Q3 earnings, which showed a double beat on both the top and bottom lines. And in addition, they also raised their full year guidance. Taking a look here, you can see some of the key financial highlights from that quarter. Total net revenues of nearly $15.8 billion, that was up 8.4%. Immunology revenue, nearly $8 billion, that was up 11.2%. And the 2 major drugs that I take a peek at are Skyrizi and Rinvoq, at $4.7 billion and $2.2 billion respectively, up 46% and 34.1% year over year from an operational standpoint. The company generated free cash flow on a year-to-date basis of approximately $13 billion, and we also got a 5.5% dividend increase. In terms of performance, the company is once again returning to growth as they went through a 2-year period after they lost patent protection on the #1 selling drug in the world in Humira. But over the course of the last year, we have seen revenue growth and, more importantly, free cash flow growth as well. Looking ahead, you can see on this fiscal AI chart that analysts are looking for EBITDA to continue to grow to record highs in the coming year and ultimately surpassing EBITDA margin of 50%, which is quite impressive. Looking here, analysts have a 2026 EPS estimate of $14.24 next year, giving the stock a forward PE multiple of 15 times. That is a reasonable entry, but if we got this stock price down closer to the $200 level, that would be a fantastic entry point. In terms of price targets, analysts rate the stock a buy with an average 12-month price target of $244, implying nearly 15% upside to go along with that nearly 3.5% dividend yield. And that's going to lead us to stock number 2, which is going to be Boeing, stock ticker BA. And when it comes to Boeing, this is one that I'm definitely very excited about from a long-term perspective. But if we fall into a slower economic period, this is also a stock that comes with heightened risk as well. So it's important to know that going in. The company currently has a market cap of $155 billion. Over the past 12 months, shares are up 28%, and year to date, up 12%. Overall, the stock has had a pretty solid year thus far. However, since reporting earnings and really over the past month when it hit a new 52-week high, shares are down nearly 20%, which has me intrigued about entering a position in Boeing. Looking back, the stock has had a whirlwind past few years. They've dealt with a few crashes of their own, and they've also had emergency doors fall off. But now the company is under new leadership, and things are starting to turn in the positive as they are laser focused on quality first, and then they're going to expand their deliveries, which is going to bring more free cash flow and more profits to shareholders moving forward. As you can see from this fiscal AI chart, back in 2018, prior to the pandemic, Boeing had revenues over $100 billion and net income of $10.5 billion. Fast forward to today, over the past 12 months, now that the company's gone through those two major crashes overseas and the emergency door blowout that caused strict oversight, revenues are down to $80 billion, with the company sitting in a net loss position for 7 consecutive years. On the positive side of things, Boeing is seeing momentum in all 3 of their segments: commercial, defensive, and global services. The stock has been under heavy pressure after reporting strong earnings, but that was also put down by delays in their 777X program, in which deliveries are now expected not until 2027. Here's a look at some of the key financial highlights from their most recent quarter. Revenue was up 30%. Free cash flow was up to $238 million, the first positive quarter we have seen since Q4 of 2023. The company delivered 160 airplanes, which was the highest quarterly total since 2018. And that back charge I mentioned to you came in at $4.9 billion, which was a dark cloud over this, what was a solid earnings report. The backlog currently is sitting at above $600 billion. In terms of valuation, looking here, analysts expect the company to turn a profit next year and ramp up growth in a big way over the next few years, which suddenly has this stock looking even more intriguing if you can withstand the choppiness that will come along with owning a company like Boeing. In terms of price targets, analysts have a 12-month average price target of $257 per share, implying nearly 30% upside from current levels. And that leads us to stock number 3, which is going to be Honeywell, stock ticker HON. And when it comes to Honeywell, there's a lot of similarities to why we're upbeat on the likes of Boeing. Because when you look at the segments of Honeywell, aerospace is their largest segment. But at the same time, this is a very diversified company. The company currently has a market cap of $125 billion. Over the past 12 months, though, shares are down 5%, and year to date, down 13%. So when it comes to moving forward, and again, I'm a long-term investor, so I'm not necessarily looking for big pops so that I can get into a stock and then make my profit and get out. These are positions I'm looking to build upon. And when it comes to the industrial sector as a whole, that's one I'm really upbeat on. But at the same time, industrials need the economy to stick together. So if the economy does in fact take a dip, the likes of Boeing and Honeywell could also see further dips in their share price. In terms of financials, not a company that will knock your socks off in terms of growth, but rather consistency. Revenues are steadily climbing, with EBITDA steadily climbing as well, and operating with strong margins above 20%. At the end of October, Honeywell reported their Q3 earnings that beat on both the top and bottom lines, and they increased their full-year guidance as the business saw strength across the board. Here's a look at some of the key financial highlights from the most recent quarter, which included organic sales growth of 6%, That also exceeded guidance. Adjusted EPS of $2.82, that's 9% year-over-year growth, again above their recent guidance. And orders growth grew 22% organically to nearly $12 billion. And the backlog achieved another record high, with free cash flow coming at $1.5 billion. That was down 16%, but that was due to more capital expenditures around timing and working capital. The other side of Honeywell that has me upbeat on the performance moving forward of Honeywell is the fact that the company is going to be broken out into 3 standalone companies, and that could provide shareholder value. The 3 companies will include automation, aerospace, as well as advanced materials. This is expected to take place in late 2025 and early 2026. In terms of valuation, looking here at this fiscal AI chart, which again is my one-stop shop for analyzing and valued stocks, and you can try it out for free using my link down in the description below. But right now, shares of Honeywell trade at a forward PE multiple of 19 times. This is well below the company's 5-year average of nearly 22 times. Looking at EV to EBITDA, that currently sits at 14.4 times, which is again below the company's 5-year average of 16.8 times. So you're getting a nice little discount here on the name. In terms of the price target, analysts rate the stock a buy with an average 12-month price target of $248 per share, implying 26% upside from current levels. And that leads us to stock number 4, which is going to be S&P Global, stock ticker SPGI. And financials is another sector I'm very upbeat on moving forward. And as rates continue to come down, there's going to be a lot of companies looking to re-rate because they want to refinance their debt. And all of that is going to be positive for the likes of S&P Global. The company currently has a market cap of $151 billion. Over the past 12 months, shares are up 3%, and year to date, they're pretty flat, up just 1%. This is a perfect example of what I was talking about earlier, with the S&P 500 trading near a record high. However, when it comes to S&P Global, shares are in a correction of their own, down 14% from their recent 52-week high. Regardless of which company you're looking at, it's always important to look under the hood, even with the S&P 500 trading at record highs. But when it comes to S&P Global, this is a high-quality company with a great management team, a strong balance sheet, and growing financial results. When it comes to those financial results, you could see that revenues have grown from $6.7 billion before the start of the pandemic to $15 billion today. Operating profits are sitting at a record $6.1 billion, and the company has strong operating margins above 40%. At the end of October, the company reported a double beat, while also increasing its full-year guidance. And here's a look at some of those key financial highlights from the most recent quarter. We saw record revenue, operating profit, and EPS, with total revenues increasing 9% year over year. Adjusted EPS grew 22%, and nearly $1.5 billion returned to shareholders by way of both dividends and buybacks. And here's what I was talking about earlier, that ratings revenue, which increased 12%, something I'm going to keep a close eye on moving forward. In terms of valuation, looking here at the fiscal AI chart, shares are trading at a forward PE multiple of 26 times. This is below their 5-year average of nearly 30 times at 29.6, as this is a stock that tends to trade at a premium due to its high-quality nature. And in terms of price targets, analysts rate the stock a buy with an average 12-month price target of $612 per share, implying over 20% upside from current levels. And that leads us to stock number 5, which is going to be Vici Properties, stock ticker VICI. And when it comes to Vici, they are a REIT, or a real estate investment trust. And when it comes to REITs, these are great ways for people like you and I to be connected to real estate, to invest in real estate. Because when you look at many self-made millionaires and billionaires out there today, many of them are tied in some shape or form back to real estate. And when it comes to Vici, they're a great company with great assets and the largest landlord on the Las Vegas Strip with properties such as Caesars Palace, Excalibur, Luxor, Mandalay Bay, MGM Grand, New York, Park MGM, the Mirage, and the Venetian. The company currently has a market cap of $32 billion. Over the past 12 months, though, shares are down 5%, but year to date, they are up 5%. When it comes to REITs in general, they have been under pressure for the most part, largely due to higher interest rates and tighter monetary policy over the past few years. But what do we have going on now in this year and moving forward on to 2026? Interest rates are coming down. which should provide a tailwind for the REIT sector as a whole. And I believe REITs are gearing up for a major comeback, and Vici could be one of those REITs leading the way. Looking here at valuation, and when it comes to REITs, we pay no attention to EPS and prefer to look at what's called FFO or AFFO. And right now, shares trade at a forward price to AFFO of 12.3 times, which is below the company's 5-year average of 13.8 times. And again, with rates coming down, I could see this stock demanding a multiple closer to 15 times, providing solid upside from current levels. In addition, the company pays a 6% dividend yield, and a dividend that's been increasing every single year that they've been a public company. And in terms of price targets, analysts rate the stock a strong buy with an average 12-month price target of $36 per share, implying 20% upside from current levels. So there we just looked at 5 new stocks for you to consider buying for your portfolio during the month of November. And there's something for everyone. Higher dividend plays, higher growth plays. But in general, I believe all 5 stocks are high quality plays. And if you found any value in this video, let me know down in the comment section and show your appreciation by clicking that like button down below. I appreciate it, and it really helps with the growth of this channel. And also, take a look at this offer. Thanks again for watching today's video. And as a quick reminder, if you're looking for a new investing platform, then check out Moomoo, which is really that next-gen investing platform we've been looking for. It is used by over 27 million people across the globe. The best part is you can get $0 commissions on stocks, ETFs, and options, and also get level 2 market data and real-time option chains. And for my viewers, Moomoo is running a special limited time promotion where you can get up to $1,000 in Nvidia shares, $100 in stackable coupons, and 8.1% interest on uninvested capital. So make sure you check out my link down in the description below.